All right, everybody, we're here again for another episode of our Asset Protection Wealth Preservation series. I'm delighted to have Tony Pescatore, CPA, joining us today. As everybody knows, the whole premise of this series is to keep what you have, and while you're growing it, to keep what you have. And frankly, I would argue that there is no larger or more significant, we'll call it a taker, of wealth than our friends at the IRS. Over the course of our lives, from an income perspective, from many other perspectives that we'll get into today, and then of course, end of life issues and things like that. And so before we dive into some of that, again, Tony, thanks for being with me today and participating. If you wouldn't mind, maybe just share a little bit about kind of who you are, background, why you're passionate about what it is you do, and then the two follically challenged individuals can have a good conversation.
That's fine. Well, first and foremost, thank you for inviting me. It's a pleasure. Always look forward to doing this kind of stuff. I started in tax after not following through pre-medicine. I transferred to Purdue, played golf there, and got a bug for the tax side of it. I had a great tax instructor there who really got me away from the audit side. Only because I did audit for 2 summers in Chicago, because you had to have an audit requirement to get your license. I've been doing it for about 30 years. And tax is kind of nice because it's a big game. The game every year is you're playing against the government. And you're trying to get the most out of what they offer on a daily, weekly, or yearly basis, depending on the client's needs.
And that's one of the things I've always appreciated about you. I think we've worked together now for about 10 years almost, maybe longer. And that your perspective is, it is a game, and I want to win that game against the IRS. So long as we stay within the parameters that are acceptable. So, well, thank you for that introduction. I guess before we get into some more like detail stuff, maybe from 30,000 feet, if you wouldn't mind just hitting on a couple things. What are some of the basics of, if somebody were to say to me or to you, hey, Tony, what do I need to be doing? What are the most common things that people should be doing? And then kind of flip that upside down and say, what are some of the things, some of the mistakes that people are invariably making that you see every year that's effectively costing them money? It's costing them part of their wealth.
The biggest thing we see, and we're seeing this more and more in the height of this COVID-19 age that we're in, you got to save for retirement. Savings, if you've read the parameters, has gone up over the past couple of years, but it's not gone up for everybody. And you do need to save. Maximize your 401ks, maximize your IRAs, your SEPs, your pensions, whatever you have set up, because it does 2 or 3 things, but the biggest thing is it does save tax currently. As you get older, your spending cycle typically drops. So my biggest thing is, if you can save now, save the taxes now, defer, it's a lot better. But we notice more and more, especially a lot of individuals, as their pay gets higher, they think, well, I know I'm maxing my 401k. And then you look at the end of the year and you're like, well, no, you're short. Now, it may not be a lot. It may be $500, $1,000. But if somebody's in the top tax bracket, $1,000 in income is $420 to $450 in tax. That it's just going away. You can't stop it. So that's the easiest stuff, is if you're working at a place that has a retirement plan, use it, because we do see the short fundings. The other part is, obviously, make sure you give your advisors everything. We see a lot of things where, and this year is an anomaly, but for the most part, if you made a payment for $10,000 and your advisor may have said, hey, you need to make this payment by a certain date. But you got to tell them, maybe make a copy of the check, because then if we ask you 6 months from now, then you say, well, I don't know. Well, I have no idea if you made it or not. But your information is your information. It's not mine. I'm merely the interpreter of it. Accountants, for the most part, are. To give you an example, they received last year an overpayment. The overpayment was $20,000. They took $10,000 and applied it, or no, $25,000. $10,000 and applied it. $15,000 was the refund check. They said they never got the refund check. So they kept asking us, where is the refund check? And lo and behold, they found that it was deposited directly into their account. We would never have known that because they're new to our firm. We didn't see anything last year other than there was 10,000 applied and they should have gotten a $15,000 check. I can't ultimately, and you see this as an advisor and other people we work with see it as advisors. You have to know more about your stuff than I do. We're just trying to help. We're the agents to help you, not the agent to memorize everything.
It almost takes you back to your pre-medicine days. I mean, I work with a ton of physicians and surgeons, and we're constantly saying we can only provide you with a plan that's congruent with your goals and objectives if we have all of the information. You,
correct.
Estate planning attorneys, asset protection attorneys, they can only do what they can do based on that information. So retirement plans, super important. Making sure to provide your advisors with all the data, with all the information. And because we just kind of talked about mistakes, I feel like I'd like to jump into what are things that you see, or maybe, and you can phrase it however you want, whether as a positive or as a what not to do, but what are some ways that people are putting themselves in the spotlight of the IRS unnecessarily? What are some things that people will do? And, I'm not talking about fraud. I mean, and blatant stuff, but things that people make mistakes, maybe plead ignorance or whatever. Like, what are your thoughts on that, Tony?
Well, the biggest problem you have is, again, a lot of the information that you receive as a taxpayer, the IRS gets. Okay, so for example, when you get your W-2, they have it. When you get your 1099s from your investment advisor, they get a copy. I mean, they have all that. So the biggest notices you see are matching notices. And matching notices are nothing more than they received X, you reported Y, why is there a difference? That's the easy stuff, because those are fixable most of the time. But for example, I love comedy, and one of the greatest comedians ever was Robin Williams. And I remember one of the skits he did. He said, if you go to the IRS and on your return, this is when he was back in the drug days. And he said, on your return, you report $50,000 in an expense for snacks, you're probably going to get in trouble. He said it a different way. But we have an example right now in the office where we have an individual who's an author. And the author for the last 4 or 5 years has had no income in regard to this book. But there's expenses anywhere from $5,000 to $15,000 a year. I could put them in the return, but then at the bottom of the schedule it's on, a Schedule C, we put deductible loss, 0. Because if I take that 5 years in a row, they're going to come in and they're going to say, well, that's a hobby. And the IRS just listed, and it's out there, I'm sure it's on their website, the www.irs.gov, the 10 things they're seeing right now. Hobby losses, which is what they would take that business that you and I would call, make it a hobby, is in the top 10 every year. When unreimbursed business expenses were there, that was in there every year. So that's one thing where if somebody can go and talk, if they work at a hospital, let's say they're a doctor, but they're really, for lack of any other term, on sabbatical, they go out and speak to groups, et cetera. Have the hospital pay for their expenses, because they're not going to get a deduction for it, but the hospital, if they pay them, does. Those kind of things, again, a lot of the computer setup in the IRS is common sense. When you look at it from 30,000 feet, if it looks bad, the computer's probably going to kick it out. Again, it's computer-based, especially with what's going on now. The IRS shut down for 5 months. Effectively, March 15th to maybe August, they've been working on skeleton or no crew. So sometime when you would get a notice right away, i.e. a month after you file the return, that might come 4 months later. Those are the kind of things, again, a lot of it, I won't say it's common sense, but if it looks odd, they're gonna notice. And it's a computer, it's not even a person.
You made me think of an ex-client now, and which will become probably fairly obvious as I kind of unroll this. But he was a radiologist making probably somewhere in the neighborhood of 800 grand a year. And he was doing it almost primarily, I think like maybe 200,000 was W-2. The other 600,000 was all 1099, like locum tenens type of thing. And so he had an LLC that he set up, and on his LLC, Schedule C, he was paying himself a salary on the 600 of about 40 grand. and then was taken, right? So you laugh. I don't even need to finish, and the remainder was all partnership distributions. And he's like, yeah, because of the this and the self-employment tax. And I go, look, man, I'm not a CPA, give him the disclaimer. I don't charge a fee for tax-related advice, tax preparation, but this is one I'm dangerous enough to know the answer to. This is going to be a problem.
It happens. Again, it's just, if it looks odd, that's the stuff you read about. For example, a business, like you mentioned, a Schedule C, a small S Corp, an LLC, whatever the case may be. The first thing every one of them say is there has to be an intent to make a profit. Now, you and I have been in business together and we've done things together a long time, 10 plus years. You wouldn't do something for 10 years to lose money. So, that doesn't sound like a lot, but it is. And that's how you have to think about it. That's what their computers, there's no personality to the computer. We all know that, but it sees something, it bounces it out because it has all the data in it.
Yeah, it's pretty remarkable, the stuff, the case studies that you end up hearing about, whether it's in your space, my space, estate planning, asset protection. We could sit over maybe some whiskey sometime and chat through a bunch of that stuff. So now let me ask you this, kind of switching gears a bit. A lot of our clients are interested in or have rental properties. And it seems like there has been, I don't want to call it a shift necessarily, but let's just say that there are competing viewpoints on, okay, you have rental properties, you should have LLCs, you should have LLCs for every single property versus, or maybe in combination with, or you should just insure the daylights out of it in different capacities. Obviously, today is the context of more of the tax aspect of things, but where do you sit on that? What's best practices? Because I feel like that's a helpful point, because lots of people seemingly are interested in this category of rental properties.
Rental properties are popular because it's in what you sell with investments and insurance and those products. A rental property, you can go touch it, feel it, kick it, see it. You can do whatever you want with it. What we recommend is, let's say it's two houses on the same street. If you want to put them in one LLC, that's fine. Personally, I would put them in separate LLCs because of the liability issue, but it also is ease of reporting. Because hey, product A or property A, this is my income, this is my expenses. You can compartmentalize everything a lot easier. Even if it's 5 LLCs, it's not going to be 5 separate tax returns. It's all going into the individual tax return. But there is the liability protection, which is more of the legal side. And for your clientele, which I know there's a lot of physicians, et cetera, I would insure the living hell out of them. And I'd make sure I have a really good umbrella insurance as well, because none of us know what's going to happen.
That's good. That's good feedback. And I'm hopeful that it's just amazing. I'll have people like, oh no, all I need is the LLC, or all I need is this. And what I'm hearing you say, which makes sense, is we need to really utilize a combination of these things to, segment out the LLCs just for record keeping, if nothing else. And then of course we've got the expenses and potential deductions and things like that, but then insure the daylights out of it. So with rental properties, that kind of makes me think of another subject. Is we have a number of clients now, I'm sure you do as well, that are getting up there in age and they're starting to think about gifting. And as you and I know, gifting cash, a lot different in many cases than gifting real estate and really everything in between. So I'm just going to let you go. Gifting strategies, what do people need to know about? And look, we can agree, everybody's situation is unique and different, right? But just broad stroke it for me, if you would, Tony. Gifting strategies.
Well, the first thing I will do is we'll talk about gifting, but more of gifting not to individuals, but to a charity. So if you have highly appreciated stock and you gift that to a charity, they're not going to pay tax on it, which is a great wealth. Let's say you wanted to set up a private foundation or a family foundation. That's an easy way to get money into the foundation, and it's an easy way to gift things later on to somebody else, i.e. a charity, etc. Gifting to family members is different. So we'll look at the real estate side. So I'm going to look at that first because we were just talking about it. Then I'll go back to the stock. Remember that when you're gifting those properties, you are gifting at the fair market value on the date of the gift. And the problem is you are gifting that property at fair market value, but the basis carries over, i.e. what you have in it, to the individual who's receiving the gift. So you're just passing the gain on to them, which is fine because maybe that person's in a lower tax bracket. Maybe they don't want the rental property, but if they sell the rental property, they're going to pay less in tax than you would. It also builds a legacy because, hey, I bought this, I want my kids to have it or use it, or nephew, nieces, etc. Stocks, it's a little bit different. We've seen more and more where the gifts of cash really aren't direct cash, but the popular thing has been loaning kids money and then each year reducing the loan by the gift exemption each year. So they're giving their kids money, but in lieu of paying it back, they're going ahead and saying, you know what, over time we'll reduce the loan amount by the gift exemption each year. So it's an indirect gift. That seems to be more and more popular, I think, with our clients as our kids get out of college, start on their first careers, etc., because maybe they'll use the money to buy a home, buy a residence, or get on their feet. And that seems to be very popular. Gifting is a great way to get money out of estates and out of your name if you have an estate liability. We're seeing a lot of it where kids are getting out of school and it's tough to find a job. When you and I got out of college, late 80s, early 90s was really tough to find a job. It's the same now. It's really tough. And I get that, but this is a way to get them on their feet a little bit.
Yeah, kind of a controlled environment. So, you know, if we're talking about gifting, I think a natural transition to that, one of the things I hear routinely is I don't really need to do estate planning anymore because the exemption is through the roof, right? I know that's not true. You know that's not true from a tax perspective, because obviously one of the talks we'll do, one of these interviews will be with an estate planning attorney whom you know, Bernie Rathor, and he'll hit it on the legal side too. But from a tax perspective, what should people be mindful of with respect to estate planning?
Okay, so talking to Bernie is fantastic because he really is good at this and he really understands it. Probate sucks. Going through it and watching families go through it, it's terrible. It takes a lot of time. It takes a lot of patience. And some of those heirs may need that money more today than others. But probate holds up the whole bus. Estate planning is important for a couple of reasons. One, obviously, titling things the proper way. You see it and I see it where a lot of clients will come in and they'll say, well, I got my estate plan done. And they show you the paperwork. And then you ask them, well, did you title everything? And they look at you, and at that point, you know, okay, it's a piece of paper, but until everything is listed the way it's supposed to, it's worthless. The other thing is the estate tax, I believe, has gone out of the tax code or been removed 3 or 4 times, and it's been added back 4 or 5 times. So under the current bill, I mean, in the political environment we're in, we have an election, in 4 months? Doesn't matter who you're voting for. But there have been issues coming out where they want to lower that exemption down to $2 or $3 million. Well, if you have a house, and we'll take your physician client, if they have a house, cars, life insurance, and it's more than a couple $1 million, they got an estate tax problem. Why wouldn't you plan for it? Because you're leaving a roadmap to not only the surviving spouse, but the heirs later on. And to me, that's what really the estate plan is. It's the roadmap for somebody else to follow. And then a lot of times, the personal representative or the trustee isn't even here. It's a friend of the family. So they're relying on what's in those documents. And basically, we get the documents and we're just trying to make sure that we follow what they listed. To me, that's the important piece because it takes the thought process. Surviving spouses and family members, they have enough to worry about after the loss of a loved one. So make it a little easier for them.
Yeah, streamline the whole process as much as possible.
Exactly.
It's one of those things that there's so much just, I don't know, everyone's a Google CPA, a Google attorney, a Google financial advisor, and a Google doctor these days. And as good as beneficial rather that is Google and the access to information is, Oh man, it can be pretty confusing pretty quickly. So speaking of, let's switch gears because I think we're in this weird 2020, right? With COVID and all this type of stuff. Let's wrap up, Tony, with maybe we'll call them COVID tax tips. What people should be doing, what they should be mindful of. What are the things that because of COVID, because of the CARES Act, perhaps, what should people be mindful of with respect to COVID and tax?
First and foremost, if you receive unemployment from the state of Arizona or these federal checks that have come out, unemployment is taxable. And typically they don't withhold tax. You're going to pay tax on them. Now, if you're in a situation where you're not paying income tax at all, or it's 5 or 10%, it's okay. But point being, you will pay tax on that. It is includable as income. It is its own line, unemployment compensation. I believe it's on Schedule 1 now, as opposed to page 1, but it is a line on there. 2, if you went ahead and applied for these small business or sole proprietor loans, EIDL and the famous PPP loan, please be advised that if you had brought up a great observation earlier, the Schedule C taxpayer who writes themselves a check, that's not payroll. Payroll means you run it through payroll, you pay Social Security and Medicare tax on that. You don't have to necessarily withhold federal and state tax, but you pay Social Security and Medicare on it, so the IRS deems it to be payroll. After we get finished with our call today, I unfortunately get to write the email to somebody and say, you received X and you wrote 3 checks to cover X, and none of them went through payroll. They didn't pay one. So now you have to take the money, move it back in, and do it the right way. It's going to cost them Social Security and Medicare tax, but by doing that, then they don't have to pay the money back. The third part is with the COVID thing, everybody who applied for a lot of those loans thinks that all of them are going to be forgiven. I think the forgiveness part's going to be the hard part, because a lot of people we have talked to believe they're going to go into their banker and talk to them about it. The banks are merely the agents for this. You are getting a loan from the SBA, not the bank. The bank is the agent. Right. So the bank is going to get, it's those old days when we were in college where you'd sit there and say, okay, now if it fits into this box, this is exactly how it's going to work. The bank is just going to have the box. If you meet all the criteria, you're not going to have an issue. If you don't meet the criteria, that's where the fun's going to begin. The last piece is you do not need to run and go and apply for this loan forgiveness immediately. The date that keeps coming out lately is August 17th. That's the date the SBA said they are going to issue how they want the banks to do this. Those loans started in April. And since April, there have been 49 changes to the program. So there's going to be more changes to the program. Let the SBA iron this stuff out. We are trying to help our clients who've got that money, but we don't even know where to start. We know some of the documentation they need, but we don't know how the forgiveness process is going to work because the SBA really hasn't said much about it. That's going to be a major issue into the fall. And now that they extended the period for some of the usage of that money, it will carry into the spring of 2021.
That's great feedback. And this is purely conjecture. Like you said, 49 changes, probably more changes upcoming. I wonder how this whole PPE forgiveness or not forgiveness, et cetera, shakes out if we have a second wave that necessitates businesses having more financial difficulty. And, do they extend that time frame just to keep helping businesses? Do they offer more? And again, this is just pure conjecture, but I can't help but think when the goalpost is continually moving, the rules of the game are changing, and we still have the uncertainty of this, presumed CDC announced second wave in October. How significant will it be? Does it require more lockdowns? But how does that then affect this? And that's, by the way, more of just kind of like you and I having some drinks, just talking about, hey, what about this? What about this? What about this type of thing?
Right, but that conjecture is what's going on. I mean, I'm getting ready to take my daughter back to school next week in Chicago. And my biggest fear is come October and November, when it gets cold, everybody's inside. They're in college, they go to bars. I get it.
Not that you and I ever did that type of thing.
Never. We never did that. Let's make sure that that's on the table.
Tony's daughter, he never did that.
Never did that stuff. The biggest problem you have today is if that spike comes back and businesses need more money, government's going to kick in. They're talking, I believe they are meeting this week to do a second wave of this individual stimulus where they send checks out to people, but it won't be as great. None of us even know what's in those bills right now. And how long are those going to last? The $600 unemployment piece goes away next week. Are they going to reintroduce that? And if so, is it going to be 600 a week, 300 a week? We're not in the room. We don't know what's going to happen. But if there is a second wave, is there going to be some medicine that slows this thing down? And until we really know, we know as much as we know, and it's very little. I feel bad for, I mean, I think the heroes, obviously, as you would know, doctors, nurses, anybody who's on the front line of this. But if you ask them, they don't know.
Yeah.
And they're going in and doing the best they can. And I mean, they're fighting with one arm behind their back.
Right.
Because I don't know how many people understand what they're going through every day.
Yeah, no doubt. Well, hey, I feel like ending on a nice depressing note is always a good thing to do.
No, not at all.
But I think the point is, with all the topics that we covered today, from the common mistakes to the basics, the typical things you should be doing, rental properties, gifting, estate planning, and then of course, COVID, to me, it fits totally in the wheelhouse of planning. Have your goals and objectives, know what you're trying to accomplish, work with the appropriate advisors, develop the plan, providing you with the peace of mind that regardless, in many cases, of all these layers of uncertainty, at least certain components of our lives are secure and are safe, and we've done everything that we can do to make sure that that's the case. So, Tony, I really appreciate your time and being with us today. I'm sure we'll have other opportunities like this because, of course, we can no longer spend time with people personally, at least for the foreseeable future. So, again, thank you so much for your time. Greatly appreciated, and your insights were spot on.
Thank you again, and it's a privilege. I appreciate the opportunity. Thank you so much.
You bet.